The yen was steeply sold off in the Asian session today as the Bank of Japan announced it will double the size of its asset purchase program. The US dollar Japanese yen took out an important near-term resistance level at 79.03, which confirms completion of a recent fall from 84.17 and confirmed the underlying bullish outlook. Euro yen and sterling yen also strengthened, in particular, with sterling yen jumping through the 128 level today. Yesterday's pullback in euro sterling helped sterling outperform the euro. But the relative strength will very much depend on today's Bank of England minutes. Nonetheless, we continue to expect European major currencies to outperform commodity currencies in the near term. Meanwhile, yen will underperform the dollar and will be the weakest one. The Bank of Japan accelerated the pace of its monetary easing by doubling the size of asset purchases, in addition to leaving the uncollateralized overnight call rate at around 0 to 0.1%. Slowdown in global economic growth and recent tensions between China and Japan over a territorial dispute are expected to delay Japan's recovery as export growth would be affected. According to the central bank, the move is expected to help ensure that Japan's economy resumes a sustainable growth path with price stability. The move came in earlier than market expectations, sending the Japanese yen lower, and the Nikkei stock index and cash bonds higher. Some Fed officials offered their view on monetary policy after the Fed's open-ended QE3 announcement last week. New York Fed President Dudley stated that the Fed's new measures aim to speed up the recovery of the employment market, and whether the QE3 would be extended beyond year-end will depend on whether we have seen a substantial improvement in the labor market outlook in the interim, and any further evidence about the costs and benefits of continuing such purchases. He added that a decline in the unemployment rate with the drop of the participation rate would not qualify as an improvement. Meanwhile, Chicago Fed President Evans, the lone dove, said the U.S. needs a more resilient economy, and hinted the bond purchase program would likely extend after this year as he did not expect to see sufficient improvement by year-end. On the other hand, Richmond Fed Lacker said that monetary policy alone is unable to offset all of the ways in which various frictions impede the economy's adjustment to various shocks. Lacker was the only dissenter at this month's meeting on the reason that more stimulus runs the risk of raising inflation. On the data front, the New Zealand current account deficit came in larger than expected at minus 1.797 billion New Zealand dollars in Q2. In Australia, the Westpac leading indicator rose 0.4% month-on-month in July. The Bank of England minutes will be the major feature in European session together with Swiss ZEW expectations. From the US, new residential construction and existing home sales will be released.